market movers. This is The Pulse.
Good morning and welcome to The Pulse. I'm Lizzie Burden in London. Well, the US and Iran have agreed to a 2-week ceasefire, sending oil prices lower and lifting global stocks. It's a temporary reprieve for the region, buying time for the two sides to reach a longer agreement to end the war. The US president made the announcement on social media, cautioning the pause hinges on the reopening of the Strait of Hormuz, and says that the US will be helping with the traffic build-up. Iran's foreign minister, meanwhile, said that safe passage through the waterway will be possible during that time, vowing Iran will cease defensive operations if attacks are paused. Pakistan, a key mediator, says that it'll host talks on Friday, though the US is yet to confirm its attendance. So for the latest, let's bring in Bloomberg Horizons anchor Germana Bassecchi. Germana, what do we know about the terms of the ceasefire? How did it get over the line when previously Iran had rejected the idea of a temporary pause? And really, when does it start?
Well, certainly there appears to be a very strong diplomatic push in the last couple of days. Chief mediator over here is Pakistan. The Prime Minister took to social media overnight in conjunction with President Trump to announce the ceasefire, a 2-week ceasefire. And of course, it is a relief. It is a relief for global markets, but it's obviously a relief as well for people in the region that the very worst case scenario was avoided. And President Trump announced that ceasefire about 90 minutes before his deadline of unleashing destruction on Iranian infrastructure if they did not agree to the U.S. terms. And that was followed up by comments from the Iranian Foreign Minister, Abbas Araghchi, echoing that they had agreed to a ceasefire, but for the foreseeable, over the next couple of weeks, any vessel looking to pass through the strait would have to do so in coordination with Iran's armed forces. A crucial point here, I think that's worth mentioning. And then a couple of hours later, it took about a whole 4 hours. We also heard from the Israeli Prime Minister as well, Benjamin Netanyahu, lending his support to the ceasefire so long as Iran stops their attacks on Israel and on the region as well, but then also emphasizing that from Israel's perspective, it does not apply to Hezbollah. So where we go from here, we know that it's a 2-week ceasefire. There is a push for in-person discussions to take place in Islamabad later this week. Iranian state media reporting that J.D. Vance could be heading up the U.S. delegation. Unclear at this point who's going to be heading up the Iranian delegation, but of course, the Speaker of the House, Mohammad Ghalibaf, is one of the names that is being put forward. And ultimately, this is a question of whether you can bridge the two sides' respective stances, because what the U.S. is asking for is very different from the counter demands that Iran have put forward, including their insistence on maintaining some form of sovereignty over the Strait of Hormuz.
And as you say, that is what's crucial for markets, the fact that the Strait was included in this ceasefire. Germana, what detail do we have on how vessels will make it through the Strait safely?
Well, we don't have a lot of detail apart from the fact that Iran are once again reiterating the point that any vessel that wants to go through needs to do it in conjunction, in coordination with Iran's armed forces. So this in itself is a non-starter for Gulf nations, for pretty much all nations around the world that agree that this should be a free maritime corridor. So that's the starting point. But we also know that there are about 800 vessels stranded in the Persian Gulf right now. Only a handful of them have been trickling through the strait on a day-to-day basis. Prior to the war, we saw about 100 to 120 vessels passing through. Now it's anything between 4 and 6. And of course, they're only getting through with the permission of the Iranians. And then overnight as well, Associated Press reporting that there is a plan being put forward in which Iran would be charging a transit fee for vessels going forward that would be split between Iran and Oman, and the proceeds from those fees would then go towards reconstruction and war reparations. That is the proposal, of course, that they're putting forward. Again, a non-starter for many Gulf nations. And I think the bigger question here is, number one, how long it's actually going to take to return back to normal, if this structure, this new protocol around the Strait of Hormuz is actually going to hold, and whether the in-person discussions can yield a different outcome. And finally, how long it's going to take for the broader energy infrastructure in the region to resort back to normal as normal as before, because as we've been talking about, over 40 sites in the region have been targeted, and many of them have been severely damaged. And we're talking about months, possibly even years, for some of those damages to be fully restored back to normal.
OK, so many years, many questions left to answer here. Bloomberg's Horizons anchor, Jemana Basechi, thank you very much. Well, because of lower oil prices this morning, notably WTI down more than 15%, we are seeing we're seeing oil majors in the US down heavily in the pre-market. The likes of ExxonMobil and Chevron there down more than 5%. And this is as we see WTI currently trading at $95.63 a barrel, but broadly futures stateside pointing higher. S&P E-minis up 2.5% and Nasdaq futures up 3.2%, following the relief that we're seeing around the world. It's not just in the stock space. You're also seeing European bonds and treasuries rallying this morning. Let's bring in Myles Bradshaw, head of global aggregate strategies at JPMorgan Asset Management, for more on that. Well, Myles, we're already seeing a repricing of Fed and ECB bets. At the moment, you're seeing Fed cut bets revived and ECB hikes being paired. You were already saying that it wasn't obvious central banks would hike as much as was being priced. So is there room for even more repricing than we're seeing at the moment?
I think so. I mean, I was looking this morning at what the oil market is pricing and the energy markets, the natural gas in Europe, and it's pretty similar to the ECB's baseline scenario, energy scenario, back from their March forecasts. And that's a world where inflation, it doesn't pass through significantly into core inflation. Growth is a bit weaker. So I think you can take out more hikes from the European central banks, most definitely. The question is, why were the European central banks raising rates? They were raising rates because their concerns were about inflation expectations. They weren't raising rates to create a recession so that there would be service deflation to offset energy inflation. It was about second-round effects. And as you're seeing the energy markets come off, as you're seeing the energy shock diminish, the risk of second-round effects comes down. The whole thing about second-round effects is uncertainty. They're not sure the pass-through. What's quite clear is the economy today is not where it was in 2022 when the Ukraine-Russian war started and energy prices exploded. Inflation's much lower, labour markets are looser, interest rates are much higher. So really their concern is about the risk of inflation expectations, and most likely I think the central banks will wait and see rather than preempting. And I think the bond market is pricing a lot of risk that actually they go ahead and are preemptive in terms of raising rates to anchor those inflation expectations.
Well, yeah, what if the ceasefire doesn't hold? In 2 weeks, do we just see bonds go right back to where they were?
I think it's possible, but I think we've reached the point where we know sort of the range that the market is likely to go in terms of pricing hikes. Let's say sort of 3 hikes from the ECB. That's the sort of worst case scenario we got to during sort of the most stressed periods of the energy markets. And I think we saw at that point the market started to worry more about growth. And I think the key thing from my perspective, if I look at risk markets, credit spreads, for example, markets are pricing inflation risks. They're not really pricing so much in terms of growth risks. Credit spreads, if you look at the crossover, is a few basis points above where it was at the end of February, yet bond yields are much higher. So I think that, if we see this energy prices escalate again, you could see bond yields go up a touch, but I think we've seen the maximum the market can price in before we start to think about demand destruction and potentially a recession risk becoming more elevated.
So you can put the demand destruction part onto one side, but is it not the case that it's going to take a long time to rebuild this energy infrastructure? It could be a while before you get safe passage to the Strait of Hormuz.
Yeah.
And then, oil analysts telling us that oil could stay elevated, not go back to pre-war levels.
Yes.
So we've got to factor all that in, surely.
Yeah, and does that mean the central banks raise rates? I think that's the critical question. And I think when you plug all the level of oil prices, what we're pricing, you could look at December, with pricing a more elevated level of energy prices than we had in February. The inflation shock is relatively small, and I think what's uncertain is the growth shock, because the economy is in a more vulnerable position than it was in 2022. And I think in that world, central banks err on the side of caution and will wait to see the economic data. And let's remember, European economy has been plugging along okay. In the UK, the unemployment rate is rising. The central bank was probably going to be cutting rates in March if it wasn't for this energy crisis. And the market is still pricing over 1.5 rate hikes this year. So I think we're pricing a lot of the bad scenarios where central banks are all focused on inflation because of the energy price, and we're not concerned about growth. So I think there is still value there in the bond market.
So perhaps the BOE doesn't hike at all?
I think that's the most likely scenario, and the question is, how does this crisis unfold, and how does the energy crisis unfold? Will they be cutting rates? That's the question I'm asking myself. Will they be cutting rates this year if this is indeed the off-ramp that we see oil flow begin to pick up from here on in through the Straits of Hormuz, with various conditions attached? Will they be cutting rates because the real economy is in not great shape?
I did think it was quite surprising at the last BOE decision that even the most dovish members of the Monetary Policy Committee, the likes of Swati Dhingra, sounded quite hawkish so soon into the war.
They sounded hawkish because they wanted to be clear that they will anchor inflation expectations. Subsequently, they've come out and have watered down some of that hawkishness, saying we will need patience to look through this. There's a range of views out there. So I think what they were quite clearly saying is a uniform message to the market and to the public: we will not let this energy crisis morph into another inflation scare. But the key thing is the economy is very different than where it was in 2022, so the risks of pass-through are much lower today. The need to hike rates is much lower than it was in 2022, and let's remember interest rates were near zero. So we're in a very different world, and I think what's happened in the bond market is you've also had a large degrossing flow, massive moves, very thin liquidity that has seen value come in the market.
So just finally, what's your take on the private credit concerns? It's been bubbling away in the background. Are you less concerned now about contagion risks when you have less risk of weaker growth because of a prolonged Middle East conflict?
I think the contagion risk, we've kicked the tyres thoroughly, and the contagion risk is really about risk appetite, risk sentiment, the closure of these. I say closure because they were always semi-liquid private credit funds that had the ability to limit the outflows, and that's what they're doing. Then affects risk appetite. It affects the availability of credit for new borrowers, and that then can cascade into slightly wider spreads. So I think that risk remains. But if you think about a systemic crisis similar to what we had in 2007, we don't have the same leverage in the system. We don't have these funds that are highly levered and need that short-term financing to keep going. And we think the system has a lot more capital, so we're not as exposed to that kind of systemic crisis. So if you see widening, it's more likely to be an opportunity to buy into higher risk premium because people are worried.
OK, great to have you on, Myles.
Thank you.
Myles Bradshaw, Head of Global Aggregate Strategies at JPMorgan Asset Management. Thanks. Well, coming up, we'll be talking to Alessia Berardi, Head of Emerging Macro Strategy at the Amundi Investment Institute, about the impact of the Iran war on emerging markets. That's next. This is Bloomberg. As details continue to emerge about the two-week ceasefire, markets are finally taking a breather from the risk of escalating conflict and surging oil prices. But the deal remains fragile, and the impact of the conflict will likely reshape the Gulf for many years to come. Ziad Daoud, Chief Emerging Markets Economist at Bloomberg Economics, joins us now. Ziad, good to have you with us. I wonder what, in your mind, are the top critical, unanswered questions now surrounding this temporary ceasefire?
Sure. So I think things had to get really bad before we got a breakthrough. And yesterday was quite bad in terms of the threats that we were hearing, in terms of the rhetoric that we were seeing from President Trump, and in terms of potential escalation that we were, that was potentially going to see in the Middle East. We have the two-week ceasefire now, and I think there are two unanswered questions that could basically make it more complicated: Lebanon and Hormuz. On Lebanon, there's an ongoing Israeli invasion of Lebanon. The Prime Minister of Pakistan, who mediated the deal, says it's immediate and it's effective everywhere, including Lebanon. The Prime Minister of Israel says it doesn't include Lebanon. So that's already one source of complication. The second one is the Strait of Hormuz, which has been largely shut for more than 5 weeks. There are questions. Will traffic return to normal in Hormuz? Will Iran continue to vet ships going through the strait? And will it continue to collect fees from vessels that are going through the strait? I think these are the two crucial questions that can complicate the implementation of the deal.
So bearing that in mind, what does the ceasefire mean for the global economy?
I think between yesterday and today, it's a relief. Let's remember that this is a season for people like me, macroeconomists, to come up with their forecast. The IMF is going to publish its forecast next week, the World Bank next week. Us at Bloomberg Economics actually are going to publish our forecast this week. And the crucial question here is what is going to happen to oil prices, and the big determinant of oil prices is the direction of war. Yesterday, oil was at 110, potentially rising. Today, or now, oil is at 95, potentially falling. That's a big relief to the global economy. That means inflation may not be as high as the worst-case scenario is. Growth may not be as low as the worst-case scenario is. And the transfer of income from consumers to producers may not be as bad as things looked yesterday.
But if you focus specifically on the Gulf, how is the war going to reshape the region's economy and security? Because it seems like the damage there will be more lasting.
Well, I think even if the war ends tomorrow, I don't think any Gulf leader will emerge from the experience unchanged. And I think all of them will face 4 questions. There's a question about how to defend borders and cities, having been under attack for more than 5 weeks. There are questions about how to deal with the US. On the one hand, US military equipment have proven to be effective in defending the Gulf cities, but US political administrations have not been so reliable. There are questions about how to provide energy to the global economy now that the Strait of Hormuz has been shut once and could be closed again, and whether they would invest in rerouting and diverging routes that have proven so effective during this conflict. And there's a question about cooperation versus competition within the Gulf. My hunch is that the 6 Gulf countries are facing common questions, but they'll probably come up with different answers to these 4 questions. OK, really great to get all your questions and answers, Ziad. That's Ziad Daoud, our Chief Emerging Markets Economist at Bloomberg Economics. Thank you. Well, emerging markets have been enjoying a global rally, as everyone has, as the ceasefire has revived risk appetite. Alessia Berardi, head of emerging macro strategy at the Amundi Investment Institute, joins us now on set. Really good to have you. I mean, this is the best day for EM stocks and currencies that we've seen since November 2022. Lower oil, a weaker dollar. Should investors be treating this ceasefire, though, with caution, given just how fragile it is?
Yeah, I think we need to treat it with caution because of the reason just said, right? We have to assess how long it will last and what will be really the sustainable negotiation between the two parts. So normally when we look at emerging markets, you look at the impact coming from global conditions, global financial conditions, and more idiosyncratic themes. Of course, this morning we are seeing a quite important relief on global financial conditions. So dollar is weakening. Core central banks' action is repricing towards less tightening. ECB, Bank of England, Fed was not really tightening, but in any case, there is a global financial conditions relief. Then you look at the domestic conditions, and then the impact of oil on growth and inflation. And even looking at that, you are in a situation right now where you will have a much lower oil price than yesterday morning, and expectations are for lower price. That means less stagflationary impulse across the board.
So does it help to draw a line under some of the vulnerabilities in EM that we had seen, particularly exposed by that stronger dollar?
Yes, it is, but we have to look at emerging markets with, they are not really an homogeneous set of countries, right? There are countries that are more externally vulnerable and others that are less. Over the years, emerging markets have been building quite important buffers in terms of external vulnerabilities. So let's start to mention, for example, reserves. So there are countries in emerging markets that are sitting on a quite important level of reserves, and that helps to defend the currencies. There are countries instead, like Turkey. We saw Turkey in the recent weeks how they were struggling to actually defend the currency through the reserves that are quite thin in the country. So we need to, again, discriminate between emerging markets in terms of external vulnerability.
OK, and just coming back to something that Ziad was saying and the questions that he was highlighting, is it that you would be more focused on what actually is happening in the Strait of Hormuz, the passage of ships through the Strait of Hormuz, than every little report about progress in potential talks when it comes to how it will impact markets?
I think the two things are very much related, right? We need to look at how the talks are going, but we need really to measure how the traffic in the Strait of Hormuz is increasing daily. So we know that last weekend there was a little blip of increase in terms of traffic, still very far away, 10% maybe in comparison to the pre-war conflict. But this is very important because in order to make these countries safe, you need to see more oil shipped to these countries.
And which countries do you expect to be hit hardest when you think about that prolonged damage because of the time it's going to take to rebuild energy infrastructure?
Of course, the net energy importers are the ones hit more strongly, right? And we have, India, we have Turkey, we have some examples across emerging markets. Asia in general is really an important destination for oil from the Strait of Hormuz, so we are really looking at how that is impacting the region, Thailand, Philippines. Overall, inflation is one of the impact, but then in order to keep inflation down, these countries are putting in place measures that are at the moment temporary, but still they are hitting more and eroding the fiscal buffer. And then you need to see how expenditure will be diverted between more productive expenditure to assistance or subsidies before really calling for a fiscal slippage. So there are several ways of this shock impacting these countries, and this is what we are looking at.
Yeah, and it's been interesting to see that regulatory response as well as, well, in lieu of or before a fiscal or monetary response,
yes,
and wondering about the growth impact of that. I also just want to get your take on Hungary, because, of course, we have seen J.D. Vance, the US Vice President, in Budapest supporting Prime Minister Viktor Orban. And I wonder how much further Hungary's markets could rally if Orban is ousted.
Yeah, I'm glad you make this question because it reminds me of the fact that we are going back to idiosyncratic themes, and we are leaving for a while the big, systemic risk. So as far as Hungary is concerned, I mean, in this new kind of environment where we do have even emerging market central banks to rethink about their next steps, Hungary's central banks is one of them where that can return to a much, let's say, more pronounced easing than what it was priced right now, right? And therefore, it is supporting our constructive view on local debt in Hungary and the Hungarian florin.
OK, Alessia, great to have you with us this morning. Alessia Berardi, Head of Emerging Macro Strategy at the Amundi Investment Institute. Thank you. Well, coming up on the programme, the shipping industry is scrambling to understand what the US-Iran ceasefire actually means for passage through the Strait of Hormuz. So we'll get you more on that in a moment. This is Bloomberg. Good morning and welcome to The Pulse. I'm Lizzie Burden in London, and these are your top stories. Oil falls the most in almost 6 years, and stocks surge after the US and Iran agree to a 2-week ceasefire. But a path to a permanent deal remains unclear. President Trump says the US will help ease congestion in the Strait of Hormuz, with the agreement also said to allow Iran and Oman to charge transit fees on ships. Plus, Israel backs the truce but says it does not include Lebanon, while some Arab states report attacks by Tehran in the immediate aftermath of Trump's announcement. Well, this is a remarkable day in markets. We have oil prices plunging below $100 a barrel after the US and Iran agreed to that 2-week ceasefire. The deal involves halting military action in exchange for Iran reopening the Strait of Hormuz to global shipping traffic. President Trump says that the US will be helping with the traffic build-up. Let's now bring in Bloomberg's Middle East energy reporter, Anthony De Paula. Anthony, just talk us through what we know about the agreement to reopen the waterway. Is it likely that we'll see oil prices getting back to pre-war levels?
Good morning, Lizzie. Well, there's a lot that we still need to know, really, before we can see any kind of normalcy returning to the market, really, because we are looking for ships to start moving out of the Gulf. As you remember, when the Persian Gulf was closed because the Strait of Hormuz was effectively blocked by Iran, it has really choked off most of the flow out of the Gulf. So we've got a lot of vessels that are in the Gulf laden with crude, refined products, chemicals, and those vessels have not been able to get out of the Gulf because of the blockage at Hormuz. So pretty much all movement stopped during the month of March. So we're going to have to see those vessels getting out of the Persian Gulf, clearing out that backlog of vessels there. And it'll be really a question of testing the waters, as it were, excuse the pun, testing the waters in terms of whether those vessels are able to safely navigate Hormuz and get out. And we are really just watching the tanker traffic there, also speaking with the shippers, speaking with the tanker owners, the producers, to see what their level of comfort is in terms of getting out and what they understand the rules are. So we've seen, conflicting plans and conflicting terms for how they would get out. So we're really going to need to see that oil start to flow and then see some permanency to this agreement that is a longer ceasefire or an end to the conflict before we can see prices getting back to normal, Lizzie.
Yeah, we just want to know whether oil can get back to where it was. But, of course, we've got to factor in all of that damage that's been done to energy infrastructure as well.
Yeah, exactly. I mean, prices were quite a bit lower when we were coming into this. Then we built in that risk premium, and then we did see damage, and we actually saw the cutoff of supply. So these are the real kind of touch points that the markets wanted to see to go higher. So we are still in that area where we've got unspecified damage because refineries have been hit, LNG facilities have been hit, and we don't really have a readout on all the damage there. Plus, oil fields have been shut in, and so depending on the how those have been shut in, the skill of the companies in shutting them in, it will depend on how long they're able to get back up. Plus, you'll need rig crews, drilling rig crews, technicians to get back in. A lot of offshore rigs in the Gulf have been evacuated because they came under attack, and that's where we've seen some of the fields halted. So we're going to need to get a little bit more certainty in the market before workers can come back in, before tankers can come back in, and before those things start moving. So right now, we're watching first for tanker movements, then potentially for some additional tankers coming into the Gulf to pick up, and at that point we might see some additional production coming on. So we need to see those things happen before we do get much lower. Prices have come down a huge amount. We're talking over 15% today, but we're still in the high 90s, whereas we were in the 60s, 70s leading into this. So we've still got a ways to go before we get back to normal, Lizzie.
Yeah, important context. Anthony, thank you. That's Anthony DePaolo, Bloomberg's Middle East energy reporter. We're focusing in on shipping. You have ship owners racing to understand the fine print of that US-Iran ceasefire and what it actually means for vessels trapped in the Persian Gulf. Just in the past few moments, we've had BIMCO, the Baltic and International Maritime Council, saying that ship owners are awaiting technical guidance on Hormuz transit. Iran says that it'll allow safe passage through the strait in coordination with its armed forces and within technical limitations. President Trump, meanwhile, says that the US would be helping with the traffic build-up. For more, I'm joined by Bloomberg's Alaric Nightingale. And Al, I do wonder, how is the shipping industry reacting to this news this morning?
It's much along the lines of how you just summarised it. I think there's a lot of caution. What is this ceasefire exactly? How agreed is it? Are all the parts of it? There are so many things that are kind of unclear. If you look at the 10-point plan that Iran is supposedly putting forward, there seem to be different kind of demands that we're seeing. So what's the actual detail of the plan? And then do you want to be the first wildebeest in the river to check if there are crocodiles? So that's if you're an owner, you're looking at the other guy and saying, "Are you going to go first?" No, you, and see, build up some confidence. And one of the things that people are saying to us this morning is they need to see others go first and see how the kind of the safety looks in practical terms when you start to see transits, and then they'll take a view. So it's a kind of a chicken and egg situation. And the same goes for insurance even. That's going to be, if this becomes a normalised situation, the first step is, or one of the key steps is going to be insurance. The very first one probably going to charge quite high prices, and then you'll find a more kind of appropriate market level as you understand the risk. So all of these kind of things are a chicken and egg process to just try and sort of figure out how safe it really is, and that's where we're at right now. It's interesting when you look at the shipping stocks in Europe this morning. You've got Hapag-Lloyd up 5%, so clearly relieved, but Maersk down 1.4%, Kuehne and Nagel only up 0.25%. I wonder, is it that different shipping companies have different obstacles to get shipping traffic back to normal? I think there's some of that, and there's probably a lot of kind of aspects of their operations and their kind of logistics that are very different. So it might be about fuel costs. If you've got a particular kind of hedged position or an unhedged position, and suddenly you've got much lower fuel costs, that could be very helpful to you. I'm not speaking of those particular companies, but you will see a kind of a fair degree of variability between two different shipping companies about how they might respond kind of stock-wise to a more kind of peaceful situation. OK, well, as you can see on the screen, it's absolutely plummeted, the amount of crossings through Hormuz, just down to an absolute trickle if you compare the left to the right of the screen there. But great to get your analysis, Alaric. That's Bloomberg's Alaric Nightingale. Well, Pakistan has emerged as a key player in helping to deliver this ceasefire between the US and Iran. The country's Prime Minister publicly appealed to both sides to agree to a truce, setting the stage for President Trump's announcement hours later. Joining us to discuss is Julien Barnes-Dacey, Director of the Middle East and North Africa Programme at the European Council on Foreign Relations. So great to have you with us this morning, Julien. Will the ceasefire hold?
Look, I think the truth is it's a very precarious situation. Both sides have seen the desire for a short-term opening here. But there are some pretty maximalist demands on the table from both sides, and I don't really see there being a great prospect of a more inclusive agreement to hold things together. So perhaps we muddle through, but I think the negotiations are going to be tricky and the situation is going to be complicated for some time going forward. I think the key question is, how much does Trump want out? He is not going to get the kind of big deal that he wants. Iran is not going to give him the kind of concessions that he has put on the table as seeking for a long time. So the question is, will he accept less to extricate himself from this situation?
Yeah, if he walks away at this point, can he really call it a victory, Julien?
Well, I mean, I think it's clearly not a victory. He's going to spin it a thousand different ways to claim a victory. But at the end of the day, the Iranian regime is still standing. It still maintains its nuclear capabilities as it was before the war, its missile capabilities. And now it's imposed itself on the Strait of Hormuz and seemingly is going to be allowed to take a toll on ships coming through. So I think it's more Iran that has reasserted a degree of deterrence, has widened its strategic posture in the Straits of Hormuz, and has really forced the Americans to back down from their demands in terms of what the desired outcome was here.
So that's the gains for Iran. But on the American side, is this war leaving the US diminished in the eyes of its allies?
I think the US comes out of this seriously diminished. It hasn't won militarily, strategically, politically. It has shown itself to be a fickle ally of sorts to many of the GCC states. It's now looking to cut a deal with Tehran that undercuts regional security and does very little to address their core interests or the core ambitions laid out by the US. So Trump definitely comes out of this a weakened president. He has been unable to deliver on what he sought to gain, and certainly the U.S. capabilities to drive the strategic agenda in the Middle East has been very weakened, and the Iranians are the ones now setting the agenda.
And how are Russia and China looking at this?
Well, I think that the Chinese, by some accounts, were involved in trying to press towards a ceasefire at the end of the day here. I think the Chinese in particular have a strong interest in seeing oil shipments resume. They have a strong demand and supply need out of the Gulf. So they clearly played a role. I think the Russians were more willing to sit quietly, watch this conflict unfold. They obviously saw a lot of gains in terms of the rise of oil prices and the lack of US military and political focus on the situation in Ukraine. So a bit of a mixed bag between the two different sides there. I think the Chinese, as I say, more looking for some kind of deal here. The Russians presumably more happy to see the US get sucked into a longer term conflict.
Just in terms of how this pans out more short-term, Julien, the semi-official Iranian student news agency has been reporting that the Iranian parliament speaker, Mohammad Bagher Ghalibaf, is going to lead the Iranian negotiating team with the US in Islamabad on Friday. What does that tell you about how talks are going to be conducted from Tehran's side?
Well, look, I think the truth is the Iranian regime has hardened, has become more securitized and more controlled by the IRGC since the killing of the former supreme leader. The parliamentary speaker is seen as hardline. He himself is affiliated with the IRGC. So this just gives you a picture of where the Iranian regime is today and what Trump has achieved since the war began. Trump has talked about a regime change, but we have not seen regime change. We've seen a hardening of the regime, and now the US is going to have to negotiate with even more hardline figures.
OK, and how precarious does it make the ceasefire that Israel says the deal doesn't extend to Lebanon? A divergence from what we were hearing from Pakistan. Do you get the sense that Israel isn't fully on board here?
I mean, my sense is that the Israelis are going to be very unhappy with this deal. We've already seen the Israeli opposition leader coming out saying it's a complete disaster. The Israelis are now saying it won't include Lebanon. Netanyahu feels the pressure to do what Trump says. He can't completely denounce Trump's agreement, but I think there's a strong likelihood that the Israelis will look to create fractures, weaknesses within the agreement, look to unravel it, to spoil the process. And Lebanon is clearly a place where they could take that forward. But if you were Israel today, you have seen a conflict unfold that now leaves Iran stronger and potentially in a position where it can cut some kind of deal with Trump that enables it to maintain its core strategic capabilities in a way that Israel was looking to bring down prior to the conflict's beginning.
OK, appreciate your insights this morning. That's Julien Barnes-Dacey, Director of the Middle East and North Africa Programme at the European Council on Foreign Relations. We're just breaking across the terminal during our conversation. We did have some latest news on the ground from Iran, and that is from the semi-official MENA news agency saying that several explosions were heard at Iran's Lavan refinery. The source of those explosions, however, is unclear. So we'll keep an eye on what's happening there. Of course, it is unclear when the ceasefire is set to begin. But coming up, biopharma in focus. We're going to be speaking to the CEO of private equity firm Jeito Capital after its new fund raised over $1 billion for clinical trial research here in Europe. That's next. This is Bloomberg. This is The Pulse. I'm Lizzie Burden in London. Well, as we take in the news of that 2-week ceasefire between the US and Iran, the Federal Reserve Bank of New York President John Williams has said that risks to inflation and employment from higher energy prices are in balance and that he favours holding interest rates steady. Williams added that he expects inflation this year to be around 2.75%. He sat down exclusively with Bloomberg's Mike McKee in New York.
To my mind, monetary policy today is really well positioned, given where all of those dynamics have been playing out, and well positioned to kind of wait and see on some of the effects of, what's happening today. This isn't, I'm not saying we're just, in some kind of we can't act. I think this monetary policy is exactly where it needs to be, and then we can respond if the situation changes. Right now, I think that monetary policy, though, is pretty well positioned, given what we've been seeing so far. far.
Monetary policy is well positioned, but what about the economy? What's the state of the economy?
Yeah, well, if you asked me this a month or two ago, we would be talking about remarkable resilience of the economy, growing at 2% last year, looking to grow even faster this year. Clearly, with the conflict in the Middle East, that changes that a bit. Consumers, families are going to be paying higher fuel costs, gas price with the gas price increases. So I've been bringing down my forecast for growth this year, probably somewhere between 2 and 2.5% for growth this year. An unemployment rate probably staying around where it is now, 4.3%. And economy that's continuing to grow, but roughly at trend. Again, driven by consumer spending and investments, especially in AI.
Well, you mentioned unemployment. You cut rates in the last year, we were told, basically to prop up the labor market. What is the state of the labor market? Is that accomplished?
Well, it's hard to read all of the tea leaves because it's a pretty complicated situation with the labor market. We are seeing some various kind of different signals. My view is if you look at the unemployment rate, it's today at 4.3%. It's about where it was in July. So we've seen some stability there in terms of the unemployment rate and in job openings and some of the other indicators. So I feel like we've seen the labor market much more stable now. Definitely not a labor market that's weakening based on the economic indicators. That said, if you look at the surveys, including the survey that we do and the Conference Board survey, that's not how people are, kind of feeling about the labor market. Definitely, we've seen a continued process of people being more pessimistic about the labor market. Not about a recession or something, but just a view that this is a pretty low-fire labor market, and maybe the views are not as strong as you would think just looking at the aggregate payroll and unemployment data.
New York Fed President John Williams speaking to Bloomberg's Mike McKee there. Well, turning now to healthcare, a biopharma-focused private equity firm has raised $1.2 billion for its latest fund to deploy money into clinical stage companies here in Europe. Jeito Capital says that it's exceeded its initial target, tapping into increased investor interest from the US. The funds will be used to help develop breakthrough therapies for severe diseases. And I'm pleased to say we're joined now from Paris by Rafaèle Tordjman, founder and CEO of Jeito Capital. So really good to have you with us, Rafaèle. Congratulations on this latest funding round. I do want to start, though, with the impact of the geopolitics. I wonder how the situation in the Middle East and the associated inflation is impacting fundraising in life sciences. Good morning.
Good morning, and thank you very much for your kind words. Indeed, it's a quite achievement with a $1.2 billion raised after the Fund 1 raised only less than 5 years ago of $630 million. And this is on a strategy that is actually very much differentiated, proven with Fund 1, and to answer to your question, independent of the geopolitical problem, because it's without cycle, without bubble, you always need new drugs for very severe patients. And we are targeting exactly the pharma demand, the big pharma who is commercializing most of their drugs, 70% of their drug, coming from smaller companies that we finance. And they are losing regularly their patent life of the drugs, and they are losing, it is estimated that by 2033, they will lose for $400 billion of revenue a year, with, for some of the pharma, representing more than 50% of their revenues per year. So Jeito is really targeting this demand, and it's without end, unfortunately, for human beings and all these patients. And it's exactly what we are targeting: the pharma demand, patient benefit that will drive the financial performance, and also the European market. So geopolitical environment has been, I would say, even helpful, because for Europe is more stable, I would say, but also the fact that we are in an industry that is very much, again, without cycle bubble. You could have acquisition for billions of, including private companies, like in our portfolio, even in a difficult environment.
But within Europe, there's a lot of focus on the need to value innovation better, to pay more for new medicines. Do you think that policymakers are catching up, moving fast enough to stop Europe falling behind?
So the richness of Europe, and it's why also we raised the first fund, but also the second fund even larger, is the fact that there is a lot of very good R&D, high quality, but there is not enough capital in Europe, particularly at the stage when we invest, which is a clinical stage, where you could anticipate the future value of the patient, the number of patients that the drug will target, and the benefit for patients that will define the price and the reimbursement of the drug. And Europe still represents, 30% of the 5 countries of the market in innovative drugs. So the richness of the R&D, needing financing is exactly our strategy. And we think we are at the right place and the right time because also of Europe. So it's even an advantage. And then you have to indeed work with different countries, but just the 5 biggest countries in Europe is already 30%, and US is 50% of the market of innovative drugs.
I'm interested as well in your thinking around the obesity drug market. What for you holds the most promise there as we move beyond Wegovy and Zepbound?
Yeah. So obesity is a very important market. It was not some years ago. Actually, it was seen more like a lifestyle almost. And then pharma realized the impact of treating obesity on consequences cardiovascular and actually to increase the GDP of countries. And we actually just done an investment with a new fund, Alveus Therapeutics, which is a Danish American company, and with new drugs that could actually avoid the side effect of the first generation of GLP-1, like Ozempic, for example. So this is a big market, and I would compare that because it's a market estimated by 2030 to at least 150 billion a year. So there is room for several players, actually. So we need to be there to finance this innovation, to then have acquisition by pharma, like we are working always with our team of multiple talents inside the investment team of Jeito to accompany and to retro-engineering the future value and the future cash flow of the drug. So yes, obesity is very important, and there is room. In a way, it's a little bit like statins some years ago, or 20 years ago, where you will have several drugs. And if I may add that we are investing in very severe cause and patient and disease, and obesity is one of them. But one comparable is also in terms of impact on the society, and very severe, is also the fertility. The decrease of natality in the world now, almost everywhere but Africa, is a real problem, including a very big impact also on the GDP. And we have invested also in this field of fertility with Repronovo. And it's interesting to see that Lilly announced that after obesity, they want to be in the field of reproductive medicine.
Interesting. You seem to be a leader in this space. Rafaèle Tordjman, Jeito Capital founder and CEO, thank you very much for your time this morning. Well, it is such a remarkable day in these markets. We should check again on the moves that we're seeing around the world. The stock 600 here in Europe up now 3.5%. So pairing some of the earlier gains that we had seen, but still oil, Brent, below $100 a barrel on this 2-week ceasefire between the US and Iran. The impact of that on bond markets incredibly pronounced. We're seeing double-digit drops particularly at the front end when it comes to yields. Just as an example, the 2-year gilt yield down 24 basis points at 4.16. And as we look ahead to the Wall Street session, futures pointing higher there too, up 3.4% on Nasdaq futures. Up next, Bloomberg Brief. This is Bloomberg.